All right. Good morning to everyone who's joined, and thanks, Scott, for joining me on today's webinar. Looking forward to having you on here and chatting through some, topic we actually haven't ever had on a webinar before. Thanks again, Scott.
Problems?
Yeah, awesome. So for the next few minutes, I'm just going to run through a bit of an Inspire update, and then we're going to get stuck into the topic. I can see there's a few people joined already, and others joining will come in as we go through. But I do want to give a bit of a heads up to a webinar we've got coming up. This is on the 7th of July, and the topic is we're actually getting a migration agent who's going to join us. And I've just noticed that there's been a bit of a in a way, I've heard from a few clients that they can't find great people, a bit of a skills shortage, and I think one of the reasons for that is because of the stop on migration, which has been had a bit of an interesting effect. So I did also see earlier this week that they've changed one of their visa rules and allowed a lot more visas to be fast tracked. So I think we're going to see a bit of a difference shortly. But anyway, 7th of July, we will have a migration agent on. If you do hire, non-permanent residents or citizens, this stuff's pretty relevant for you. So Rose has posted the link in the chat box, and looking forward to going through with them all about how we get good people hired. So next one is if you, this is a bit of an offer. If you do want to work with us, you're considering it, feel free to book in for a strategy call with an accountant. Again, Rose has posted that link into the chat box, and we're happy to have a chat with you about how we work and all that sort of stuff. So feel free to do that. And a bit of an interesting one on our Save Tax update. So this is the first time we've given a public update in weeks now. There's a reason for that because we've been pretty flogged. The accounting team has been working extremely hard to deliver tax planning for our clients. I guess we set out at the start of this tax planning season to save $2.1 million in tax. And the the interesting update is we've actually hit almost 3 million. So we've more than doubled our target as of this week, and we've still got another few days left until 30 June. So our team is stoked, and clearly we set the bar too low, or the target too low, and so good that we've been able to save our client base, over $4 million. We're blown away as a team, and through our Day for a Dollar campaign, we've given, through B1G1, we've given over 4 million days worth of food, access to food, water, health, and sanitation, which is pretty incredible to have that sort of impact. So thanks again. I can see a few clients in here, pretty impressed with our team on that one. So that's a bit of an Inspire update out the way. And I do want to introduce our guest today. We've got Scott McGregor on from Mortar Finance. And just a bit of a brief intro to Scott. Scott's worked for two of Australia's big four banks in the last 22 years. And the area that he works in is business lending or commercial lending. In terms of some of the specialties that he works with is manufacturing, professional services, and property development. There is more than that he's done. He's really experienced with this commercial and business finance. So really looking forward to having him on. In fact, we didn't have a slide for it earlier, but we will be having Scott back on another webinar later in July. The focus of this one is all about funding your next acquisition, your business acquisition. So that's all about the business side. We will have one late next month on property development. So we've got lots of clients talking about, hey, I want to buy a house, subdivide it, build two houses, sell the two, that sort of property development, some even bigger commercial stuff as well. But we'll dive deep into property development with Scott next month. But the focus on this one is all about business. So thanks again, Scott, for joining. Really looking forward to this one. And just to add, we've got a couple of clients I can see, and I've even had a few conversations with people who have joined about acquiring a business. So I want this to be really interactive, and feel free to ask questions as we go. And I'll keep an eye on the Q&A box to to guide Scott on the questions that are coming through. But please ask questions. Over to you, Scott, and I will kick off with your first slide.
No worries. Thanks, Ben. Thanks for having us, and welcome everyone to today's webinar. I thought I'll keep this reasonably high level to start with, because there's a number of specifics in terms of acquisition finance that we could go into, which hopefully will come out of the Q&A if there's any specific questions around that. But I thought I'd start with effectively the 4 C's of funding, which the bank's going to look at for really any sort of transaction, but it is applicable to the acquisition space. And I'll tailor this a little bit to some of the key points that banks are going to look for from an acquisition point of view. The first thing the banks are going to look at is the character of the applicants. So that really comes down to the management experience and their skills, the industry that they're operating their business within, who are the key people in that business. And I suppose when we break that down to an acquisition, if you're buying a business that you don't have any experience in, that's going to be something the bank's going to want to understand how that's going to work. There may be some key people within that existing business that you're going to retain through the acquisition. And it's important to understand who those people are. If the business you're buying is very reliant on the previous owner or a sales manager or someone like that, if you can't secure their services in the acquisition process, then it may have an impact on how that business is going to trade going forward. So the all-up understanding of the character and the ability of the applicants to buy and operate that business is going to be fundamental to the bank getting comfortable with you as an applicant for finance. So some of the things that people do there is have conditions within a contract that the previous owner will stay on for 12 months or something, to help with training and upskilling to get into that business and help with the transition process. Sometimes under franchise arrangements, the franchise group will provide ongoing training and support to the new business owners to help them get comfortable with what that business is going to be like to run once that franchise person steps away. The second thing the bank's going to look at is the capacity, which is effectively the ability to repay the loans. Now, that's what the bank refers to as the primary exit, and how the business's cash flow will afford that loan repayment. So traditionally, the bank's going to look at a forecast or some sort of document of what the future earnings of that is going to be, and the capability of the management to actually be able to execute on that forecast. So it'll be important for the bank to understand what assumptions you have made in regards to that forecast. If you're buying a business that is complementary to an existing business, then how are you creating synergies between the two businesses? Is there ways that both businesses can leverage off each other, potentially saving on costs through shared resources and those sort of things? So they're the assumptions the bank's going to want to understand in terms of your forecast as to how that loan is going to be repaid.
Yep. Just on the cash flows, Scott. Is that obviously the bank will look at the context of what's happened in the past, as well as when they're keeping in mind their projections. Like, they won't just go off projections for a funding. It depends on maybe the industry, or
it does. It will depend on the industry and also the type of business. So the other important factor there is the vendor figures. So if you are buying an existing business, there will be some vendor information on that. And I'll would thoroughly recommend a fairly exhaustive due diligence around that, involving your accountant in that, because vendor figures are the vendor's figures, but often there is add backs and other things in there that the vendors will they will confirm them as add backs, but you need to really understand, are they really add backs or not? Because if they are a general expense of that business ongoing, you need to make sure that the business can actually afford that. So it's always a strong recommendation, and the banks are going to want to understand what due diligence you've done around the vendor figures, because as Ben said, they will provide a guide to future earnings, but it does depend on how you're structuring it. Like I said, if you're able to leverage off an existing business, that may have an impact on what the forecast looks like in comparison to the vendor figures, who may not have had that same leveraged position. Similarly, if you're acquiring a fairly new business, it may still be developing cash flows, and the vendor figures may not have a huge amount of relevance. So it is a case-by-case basis, but yes, certainly understanding the vendor figures is key to understanding where the business is going to go.
Got it. Yep.
The other thing to that is the drivers of that cash flow. So the drivers there can be sales or margins or expenses, but similarly, if you've got a business that has stock, debtors and creditors, understanding how much stock needs to be held, how often that stock is converted and sold, and therefore the speed of generating cash flow in the business, how long your debtors generally take to pay you. And another one that's important is your supplier terms. So what I often see with a person buying a business is a previous vendor may have been getting 30 or 45 days supplier terms. A new owner comes in, the suppliers don't know that new owner, and they may be on restricted terms or even cash on delivery. So it's important to understand how a change in supplier terms is going to impact your ability to fund the business and meet repayments. Because if all of a sudden you're paying for suppliers on day one and you're not getting paid from your debtors for 30 or 45 days, that can have a cash flow requirement that the business will need to understand and be able to fund. And maybe there's an overdraft or something that needs to be provided to assist with that cash flow cycle. So these are all the important things to understand when you're looking at buying a business, and how the bank is going to assess that cash flow. As I said there, it's the primary exit. It's what the bank is really relying on to actually repay those loans. Moving that forward one step is the collateral or security, which, as I said, there is the secondary exit. So it is I suppose it is a fallback position to the bank if that primary exit doesn't support the repayment of the loan. So,
and sorry, just for exit, I think the context for that is the bank exiting their loan with who they're lending the money to. So their exit strategy to get their money back. Yeah.
Correct. Yeah. So the primary exit strategy is you get a 10-year loan, the cash flow pays that loan off over 10 years.
Yep.
The secondary exit strategy is, unfortunately, the first exit didn't work and the cash flows aren't there. Yep. How is the bank going to then look at that loan from an ability to actually get those funds back? So they will look at different options for security. So the first one there, and it does apply. It does depend on the structure. So the structure of your business would be something that you would work through with your accountant as to how you set that up, whether it's a company, a trust, a sole trader, and the bank will tailor their security around how that structure is set up. So if you have a general security agreement, it's in the slide there as a GSA. That is over a company or a corporate entity, and it's effectively a mortgage over that company. So it allows the bank to secure cash flow. It allows the bank to secure the assets under that entity. And in a worst case situation, it allows the bank to appoint a liquidator to that company. So the GSA, or general security, is a very important document from the bank's point of view. The second one down, again, assuming a company structure with directors, the bank is going to look for personal guarantees from those directors. The guarantees are important for a bank because they like to see that the owners of the business are putting their personal positions behind their funding requirement. So it shows the bank that you've got a vested interest in making the business work and that you're standing behind the business by providing that guarantee. We have seen instances where, the banks will actually proceed without a guarantee, but there would need to be some fairly strong factors around the transaction that allowed the bank to get comfortable without that guarantee. Which brings to the next point: property security, residential or commercial. The strength of that security may allow for the guarantee position to be addressed, but it also allows for a stronger pricing point as well. So having property security in a transaction will allow the bank to actually acquire those funds off the market at a cheaper rate, which then means you can get a cheaper rate for your finance as well. So as well as providing the security to the bank, it actually can provide you a benefit in your cost of finance.
Cool.
Some other types of collateral or security the bank may look at there is a strong debtor or inventory book. So they may look to take security over those particular assets to provide a higher level of funding. So businesses that do hold lots of stock, as long as there's no issues around that stock being obsolete or market changes, those sort of things, But if you've got strong debtors and strong stock, it may give you the ability to fund a higher amount than potentially a business that doesn't have those sort of assets. And similarly for the equipment or plant. So if you're buying a business that's got a lot of trucks or machinery, there's an ability for the bank to value those assets and actually take security specifically over those assets and provide some funding. So you could be buying a transport business whereby the funding is purely made up of asset finance against the fleet of trucks, for instance, which will help in terms of how much funding that you could actually obtain for that business.
Yeah, cool.
So the last point there is around the CapEx, and it's important to understand when you're buying a business is there's often a purchase price. You might have to buy some stock, but if that business has a high level of core trading or working assets in their machinery type equipment, it's important to understand the useful life of those assets and where they currently sit within that useful life. Because if in 6 months' time you have to replace half of your plant and equipment, you need to be able to forecast and budget for that, and also understand whether you can actually finance that. So it's important to understand what operating assets are in that business and what future requirements you may have around those assets to ensure that when you approach the bank at the start, you can get appropriate finance for any future requirements around that. The last point I wanted to make there was just in regards to the working capital. And we sort of touched on it before with the suppliers and the debtors, but if you're buying a business that is providing sales, where you're going to have debtors, it's important to understand in your cash flow how long it's going to take you to actually get paid from those debtors, and the funding that you're going to need to obtain in the meantime to pay your rent, to pay your wages, to pay other operating costs until the business starts receiving its own cash flow. So again, that might need an overdraft. It might need additional cash flow put into the bank account of the business to help it continue to trade until those sales start turning into actual cash flow into the business. So important to understand that, and the bank will want to know how you've understood that working capital cycle in terms of making sure we've got the appropriate funding in place.
Yeah, great. All righty. Well, thanks for running us through that. And I guess just to sort of recap, that first one, character, is the business a fairly decent, fairly sort of low risk approach in terms of their makeup, their history, all that sort of stuff. Then we got capacity to repay, which is almost like when we go and get a house, they want to check that our income can repay the debt. That's kind of first one there. Collateral, we're going, well, if that didn't work, then can we sell everything and still get our money back? That might be kind of what they consider there. And the last one is just making sure you're not buying something that needs heaps more cash anytime soon.
That's right. Or if you are, that you understand what that is and it's planned for. And potentially, if it's asset finance, that the bank may provide a pre-approved asset finance limit so that when it comes time to replace that piece of machinery, the funding is already in place to convert that and turn that over, and at least then you know that you've got that side of things covered.
Yeah, beautiful. That's great. And Mark, I can see your question in there. What I might do is we'll get through the next couple of slides because it might be partially answered in that. But just a reminder to anyone else who is watching and you've got questions coming up, just please pop them in that Q&A box and we'll run through that stuff with Scott. But yeah, did you want to run us through the industries?
Yep. Look, these industries are by no means exhaustive. It's just this highlights a few of the industries where a lot of banks have specific policies around lending to these industries. So accounting, insurance, legal, etc. That the banks have enough exposure and comfort across these industries to design specific policies that allow, I suppose, provide a lot more guidance around how they're going to be structured. But it also potentially gives us access to a higher level of funding because the bank has a certain comfort and a certain policy around these types of industries. So anything that sort of falls outside of this, it doesn't make it any, I suppose, easier or harder to fund, but it just probably falls back to standard business assessment criteria as opposed to a specific policy around these sort of things. And I won't go into the specifics because each bank we deal with will have a different policy that relates to accounting industries, for instance, but they all do have a particular policy around how we might lend to an accounting business or a financial planner, or a doctor, for instance. They will look at those sorts of things. So yeah, so I just wanted to flag that there are specific industries there that will have certain policies. Anything outside that, then again, as long as we can understand the business, the repayment, the security, then we can still have still put a good application together and have a good conversation with a funder around putting some facilities in place.
Yeah, fantastic. That's good. And again, like anyone watching who wants to ask a question about some of these specific stuff, like I know there's a couple of accountants and financial planners who have registered, and we've got clients in manufacturing's not here specifically, but yeah, feel free to ask specific questions if you do want to do that. We will have time.
Yeah, the manufacturing probably comes through into that built industry sort of area where we'd have some options around. I mean, in manufacturing, you generally find businesses that do have strong debtor positions. They may have holding a reasonable amount of stock, and also a lot of machinery. Might be laser cutters and other things in a manufacturing business that hold some value that the bank can actually look at leveraging against to help fund a business acquisition.
Yeah, beautiful. That's good. All right,
so
rule of thumb.
A little bit of a rule of thumb in terms of how banks will look at some of the funding. So the first one there is a bit of a shared risk. So banks are going to want to know that the owners of the business have got some skin in the game. Industry term there of hurt money, but it basically looks at a shared risk position, so that if the bank's coming in, the owners are coming in, and both parties are contributing to the success, I suppose, of that business. Now, that may come in the form of cash, buying business for $200,000. Customer puts in 100,000, bank puts in 100,000. Fairly straightforward sort of transaction, or an equity contribution, and that equity may come from a residential or commercial property, and banks will look at those up to 80% of the value of the property for residential, 70% of the value of property for commercial. Important to note, less any existing loan that is already against that property. So it is looking at an equity position up to those numbers. Potentially, it may be a situation where if there's equity in a property, we actually look at increasing a home loan or a loan against that property to generate some cash to then contribute the cash to the business purchase, as opposed to putting the property in as security. That becomes a conversation we'll have about the positives and negatives of each option, and which way it works for the business owner to structure their funding. You may end up with, if a business is under a particular franchise agreement that may have preferential funding with the bank, there could be security around that allows the bank to get a bit more comfort. If you're buying a McDonald's franchise, for instance, you'll probably get a higher lending than a 50-50 because of the brand behind that business, as opposed to maybe setting up a florist in a strip of shops. That would probably look back to a 50-50 side of things. So the franchise or industry or brand behind a business can also help in terms of how much equity you need to contribute to that purchase.
And does that also, like certain industries that we might have gone on the previous slide, certain industries there might have higher loan to value ratios? Is that a potential as well?
Yeah, it will. So a lot of the industry rules with the previous slide will be a factor of income. So a lot of so if you're looking at a rent roll business, for instance, that a real estate agent has a portfolio of rental properties that they manage, that generates an income, an accounting business, financial planning business, a legal firm, they will often look at those as a multiple of income in terms of a dollar amount of lending, as opposed to a 50-50 split, that sort of thing. Generally, the way the policies do work, though, is they shade those multiples to sort of come back to roughly a 50-50 split anyway, but just a different way of skinning the cat, as they say. So there's so that's sort of where that may come in from the industry point of view, in terms of leveraging against a cash flow position. Another important point to note here is vendor finance. So we do see a lot of business acquisition where the vendor is quite happy to provide some finance to the buyer on that business. it is accepted by the banks, but it is probably lower on their appetite scale than having genuine cash or property equity into the transaction.
Yeah.
But as long as the bank can understand the vendor finance agreement, have that provided to them, potentially have their lawyers read through it to understand how it may impact on the bank debt. Some vendors will want security over the business. So if the vendor's got security over the business, the bank's going to want to know that the bank can have a preferential security position over that business. The vendor finance agreement may include terms around how any enforcement action from the vendor could be triggered. And I have seen some vendor finance agreements whereby one missed payment under that vendor finance arrangement can trigger enforcement action by the vendor.
Yeah.
Now, if they have a general security agreement over your business and they enforce against the business, the bank really has two options there. They can either pay out the vendor to stop the action, or they end up joining the action with the vendor. And that's where the bank then obviously wants to be very comfortable around that agreement before they get into that position, because it can leave the bank with really limited options in terms of what they do, which is why it's important for the bank to understand what that vendor finance arrangement is. So it is certainly something that is able to be done. As long as all the parties can understand how it works and be comfortable with it, then it is a valid option to having some additional support or finance around the business. And I suppose back to the capacity issue, if you've got a repayment to the vendor and a repayment to the bank, the bank's going to want to understand that the business can still make or afford all of those repayments, not just the payments to the bank. So that comes back to the capacity side of things in that earlier slide.
Too easy. And just while we're talking about LVRs or loan to value ratios, Glenn's asked a question. He says, will the banks loan 100% of the purchase price, or do they still look for that particular? And from what we've kind of talked about now, it sounds like it's very industry specific, but have you got any other ideas on how they might lend 100%?
Look, in general, a bank's not going to want to go to 100%. However, if you had security outside of that, so if you had a residential property that was free of any debt and you put that property in as a security, then the bank would, as long as there was enough to cover 100%, then a bank would entertain that transaction up to 100%. But if it was just buying a business with security over the business and a director's guarantee without any sort of other property or security behind it, it'd be very hard to get 100% finance for a business. I mean, even a residential property, banks are going to look for a 20% deposit, and that's a bricks and mortar asset. So as a general rule, you're going to need to have some contribution in there. The other issue with funding 100% of the business is the amount of debt then that business is carrying. So the more debt that you're carrying in the business, the more the cash flow is going to be tested or I suppose required to cover a loan repayment. So putting some cash in also gives you equity in that business. It also reduces the debt level and reduces the stress on a cash flow. Especially as a new owner, you might be sort of trading up or building up the business. 100% finance on day one, can test the cash flow. So there's a number of things there to think about when we actually look at how much the business is actually going to borrow.
Yeah, cool. And I guess maybe this is a lead on from a previous webinar about a month ago we held with a lawyer who does sort of mergers and acquisitions, and the topic was growing through acquisition. So a lot of the people who join and our webinars are existing business owners. And would a situation where, let's say that their business was worth $500,000 and they were looking at another business acquiring and at the same type, let's say it's an accounting business and going to acquire another accounting business of a similar value, 500 grand, is that acceptable for skin in the game for business and they take security over both, assuming the first one's got no debt on it?
Yes, and it could be a situation like that where you are acquiring a competitor or even potentially a supplier and getting some vertical integration within your business. So you could certainly look at leveraging the assets of one business to then buy a second business, and it would come down to what the bank was comfortable with as a lending position against the first business, and that could be assets in the balance sheet. It could be a multiple of earnings. Again, it would depend on that type of business, but certainly, and potentially more possible within some of those industries where there's a policy around the lending. But otherwise, if you had a business valuation, yes, you would find that a business would look at the combined value of the two, and assessing a loan position against the combined value of the two businesses, and getting comfort around that. And obviously, then you've got the cash flow from the first business that can help support the second business in terms of that acquisition and growth strategy.
Yeah, great. Okay, now that is very clear. We do have a couple of questions still, but what I might do is we'll go to the next slide, and then the one after that is actually for Q&A. So thanks, Mark and Howard. I might just hold on those questions until we cover this one. So
yep, no worries. There's just one thing I wanted to cover on the previous slide, just in regards to identifying risks, mitigating them appropriately. I mean, there's a number of different risks that could be involved in a business purchase, and it is going to depend on the business and the industry. So they're probably going to be more specific to an application as opposed to me going through them all now. But an important one to bear in mind is a lease. So if you're buying a business with a lease, it's important to understand the terms of that lease. How much the rent is, what's the expiry of the lease. Is there a bank guarantee that you're going to be required to put up for a rental bond under that lease, because that will add to your funding requirement? Who's the landlord? If you get a chance to meet the landlord, that would be ideal, because a good or bad relationship with a landlord can have a good or bad impact on your business as well, depending on the type of business. So and importantly there as well, if you've got a 3-year lease in place on the business you're buying, the bank is going to look at a loan term that aligns with that 3 years. So a short lease is also going to mean a short loan, which could then increase your loan repayments. So it may be a chance when you're buying the business to renegotiate the terms of that lease, but certainly understanding the lease terms, because technically once the lease ends, you may not then have an ability to run your business. So it is something to certainly understand as part of your due diligence process, is the lease that's in place.
Yeah, good point. I guess that's probably more relevant for the bricks and mortar reliant businesses, rather than maybe professional services where you can pick your laptop up and walk into the next office.
Well, you could, yeah, that's right. And that's a different, but if you're in a manufacturing facility, the cost of moving from one shed to another could be fairly substantial. And obviously the downtime of your business while you're not trading and those sort of things. So it can be something that is certainly, it would be a question the bank would be asking anyway. So it's worth understanding the terms of that for your own due diligence.
Yeah, perfect. All righty. Lenders.
Okay, so these are some of the lenders that, is certainly not an exhaustive list, but some of the lenders that we would typically use from a commercial lending side of things. And I suppose underneath it is just a little bit around where they would normally, I suppose, focus their attention when it comes to a transaction. So someone like Judo Bank, top left, they're very big on the management of the business. It's sort of been their marketing strategy, I suppose, in terms of their position in the market is backing the owners of the business to get the job done. So they will put a lot of focus on who is actually running this business and their skills to do it. Macquarie, for instance, very industry focused. They're great in professional services, in medical, in technology. So they will back themselves in those industries, but then they don't really play much in the other industries outside of that. So very specialized in some industries, but very good at those industries that they do. ANZ are really going to look at that 50-50 contribution. How much money are you putting into this business? And does it match what the bank is doing? And then an interesting one was Suncorp at the bottom. So they have a policy whereby if you're putting in a property, they will, their policy allows up to 200% or double the bank value of that property. So if your property is worth 500,000, the bank value at residential is 80% or 400,000. So Suncorp will have a policy up to basically $800,000 in funding, again, excluding any mortgage. So if you had a mortgage of 100,000, you've sort of got $600,000 to play with in terms of their policy. Now, obviously, they still need to meet character tests. They still need to meet capacity tests, but it does give a lot of option in terms of how much we can actually fund through a business purchase if there's a property behind it.
Fantastic. Cool.
So and but all the banks will have their preferred industries and not preferred industries, and I suppose the advantage of being able to work with a number of different banks is we can have those conversations and find out which industries are preferred and which industries aren't, and each bank, like I said, will have their niches they like to play in. So it's really just about having a conversation with them, understanding the customer's business and what they're trying to achieve, and matching the bank to the business. And that's pretty much the end of the presentation. I think there were some questions there, so more than happy to take those now.
Yeah, okay, and there's more coming through as I look at them. But so Mark's asked, what's the best way to get a business loan for an existing 6-month-old business?
Well, the best way, I mean, you would need to have 6 months trading is not a huge amount of trading from a bank's point of view, but certainly you need to have that information up to date. A very comprehensive and rigorous forecast on where that business is going, and the assumptions behind that. So that might be a new contract has been won for the business, which is going to generate X amount of cash flow that the bank can then rely on. But it'd also be a thorough understanding of the current business and the new business and how they might be working together. So there'd be a lot of research around both businesses and the ability to repay. Certainly not an impossible ask, but 6 months trading is not a lot for the bank to work on. So it's going to be really around how we can understand the story and convey that message to the bank for them to be comfortable.
Yeah, perfect. All righty. So I'm just having a read through and trying to pick an order. Wonderful. So this one's a little bit easier. So would you apply to multiple banks at the same time for funding, or just stick to the one you have a relationship with?
We have conversations with a number of banks to understand their appetites, but generally we will then, once we work out each different bank's appetite, their viewpoint to a transaction, potential structures that they may want to put in place, and understand exactly where each bank's position is. We then have a conversation with our customer to, I suppose, go through those different structures and interest rates, security positions, all those things are important there. Work out where our preferred option is, and then we would apply to that particular bank. So having an application with 3 or 4 banks isn't always the best way to go. It's for us, it's about understanding which banks can deliver on what sort of criteria, and then working out the most appropriate one to then put an application into. When we apply to a bank, they will often then do a credit check, and the more credit checks you have on your profile within a short range of time can actually impact your ability to get finance. So it's important for us to understand what our clients are looking to achieve, what banks can help satisfy that requirement, picking the best one and going from there. Now, that doesn't always mean that bank will come back with an approval, and that might mean then we do have to look at another option, but we do as much research as we can up front to make sure that when we actually do put an application to that bank, we figure we've got a better than good chance of getting that loan application approved.
Yeah, fantastic. So we're not just burning the credit file.
Yeah.
Yeah, cool. All righty. Thank you. Howard's asked, how do finance providers approach pre-purchase structuring? For example, if the business has high cash reserves and retained earnings, declaring dividends prior to purchase. So, and that's more maybe an accounting-y thing, but yeah, let's say a business has $500,000 of goodwill that the buyer wants to buy, but the company it's in has $1 million worth of retained earnings. How would the banks like that approached?
It's an interesting one. I mean, the banks are always going to want to understand any sort of dividend strategy around a business. So if there is a retain dividends coming out of the business and where that might be going will reduce a business's ability to to repay the debt. So if there's a dividend strategy that 100% of profits are siphoned out of the business every year, then a bank may want to understand what that is, and they may actually covenant around not taking that much money out of the business. If it's a strategy of a growth strategy whereby a business might declare a dividend to then release the cash to then put towards another business, then that would be acceptable as long as the bank understood how that was transpiring and the benefits of doing that. So it's a hard one to answer specifically. It really comes down to explaining what's happening and having the bank be comfortable with that explanation, and being comfortable that there's not going to be any future impact to an ability to service the loan or impacting on the business's balance sheet position that may then impact on asset values and that sort of thing. So it really comes down to an understanding exactly the purpose behind that transaction and how that's going to impact on the future for that business.
Yeah, cool. All righty. And Tanya has asked, is there key elements of a business plan that banks put emphasis on? Actually, we've got two questions around the business plan side of things. And is that going back to our character bit?
In essence, yes. So the business plans are handy. It gives the bank an understanding of the borrower's thought processes around that business, and I suppose the fact that they've had those thought processes around the business, because it is very common for a lot of applications that we can see, and I saw this previously in the bank, where that sort of thought hadn't really come through, and when you ask those questions of the borrower, didn't really have the answers. So the fact that you've taken the time to prepare the business plan shows that you've actually put that thought behind it, which goes to the management experience capability piece within the character. But certainly, if I'm looking at the business plan, I'm looking at a couple of things, and that is who are the people behind the business. So bios, resumes, that sort of thing on the people that are running the business. And one thing that's in a lot of business plans is a SWOT analysis, which is your strengths, your weaknesses, opportunities, and threats, and a thought process around those. So, what are the strengths of the business or the owners? Where are the weaknesses in that business, and how are they potentially using the strengths of the business to overcome that? What opportunities for growth or for new business that the owners have identified within the operation, and those opportunities may then be factored into a forecast that they've built and some of the assumptions around that forecast. Yep. And then what are the threats to that business? And it might be industry related. It might be you mentioned at the start of your presentation there about trying to find the right staff and a skills shortage within the industry. So things that could be threats to your business, which then become risks that the bank is going to want to see. How have you mitigated that? What are you doing about that? So those are the two important things that I would look at in a business plan, and it really comes down to the owners and their assessment of that business.
Yeah, cool. And I think that answers Mark's question as well. So thanks, Tanya and Mark. Another attendee, Zach, has asked, can you provide some insight around timeframes? So how long do the transactions take?
Again, it is bank specific. So and potentially the size of the transaction as well. So a lot of from a business banking point of view, the banks have small business areas, and they have SME type areas, and then they have larger departments that look after different sized businesses. So the size of the business and the funding requirement can impact on the turnaround. If there's a specific industry policy that we're working towards, that can impact on the turnaround. So for instance, if we're working under a specific industry policy that goes to a banker that is specialized in that industry, that may turn around quicker than if we're in a general business environment that's not industry specific. And the time that we apply, so certainly at the moment being the end of June, we'll see timeframes extend a little bit because there's a lot happening with the end of financial year coming about. but that's all part of the research that we would do up front. So we would have a conversation with a number of different banks, and as well as their policies and processes and interest rates, we'd also be asking them how long it's going to take them to put an application together. And the difference between 4 and 6 weeks or 1 and 2 weeks could be the difference in the lender that we actually choose to go to, because there might be a business that you've got a due diligence or finance clause on that you need to meet. So if we're aware that there's 30 days due diligence, then we're going to look to lenders that are going to be able to deliver an outcome within that 30 days. I would generally say, as a rule of thumb for buying a business, a due diligence period of probably 60 days is at a minimum, because there's a number of things that need to be worked through with a business purchase, a little bit different to a home loan. You'll need to engage accountants and solicitors to do due diligence around the lease, around vendor financials, preparing a forecast, doing a business plan. If you're looking at funding against assets within that business, the bank may need to get valuations done on those assets. The bank may want to value the business, depending on the type of business that it is. So those processes can take longer than a residential purchase contract, where we might be reviewing some PAYG pay slips and a purchase contract. So the nuts and bolts of getting a business application together can take longer. So I would generally recommend, minimum 30, ideally 60 days as a due diligence process, just to make sure that you've covered off on everything within that process. That means you've made the right decision when you buy that business.
Yeah, perfect. Alrighty. And then part 2 of the question is, do you have any insights into the sort of the two main purchase structures? So one of them is company share purchase, and so buying the shares in the company and potential whitewash requirements. So that's kind of one option, versus a going concern purchase.
Yeah, well, in regards to the shares in the business, so if you're buying shares in the business, then there is whitewash provisions, which it's a section in the Corporations Act that we need to be aware of when buying shares in the business, and it can particularly be triggered if the business is then providing a guarantee back to those owners to link in the income from that business. So it's something we need to be careful of. The banks. Us as finance brokers will engage with accountants and the bank's internal lawyers to make sure that process is completed correctly and doesn't leave anyone exposed to any sort of breaches of the Corporations Act. So that is certainly one instance where someone will just come in and buy the owner's shares in that business and continue to trade that business. Other instances is where you come in and particularly you buy the business, you buy the brand, you may even change the brand of the business into and roll that up into your own business. So again, that probably comes down to a conversation with your accountant as to the most appropriate structure for you in terms of funding that business. I suppose what I'll say there is, regardless of the structure that you do decide to proceed with, whether you're going to buy shares, whether you're going to buy the business as a going concern, and whether you're going to structure that as a company or a trust or a sole trader, as long as the banks can understand that structure and how that's going to work, identifying any potential implications around whitewash provisions and things like that, the bank's generally going to be able to work with that structure to provide a finance arrangement. It may then just vary some of the information that needs to be provided, and also the way the security is structured, because of you don't get a director's guarantee, for instance, if it's a sole trader who is buying the business. The sole trader is automatically liable. So those sort of things will need to be understood and confirmed when we present something to the bank.
Okay, so structure is typically that is very, very relevant for every party, the lawyers, the accountants, the bank, the owner. There's so many interesting things involved there. So yeah, that's, I guess, complex.
Well, it is, and I suppose that's where we would defer to yourself, Ben, there in terms of working with the customer as to the most effective structure for running that business. And these are conversations you would have in terms of where that business is going, if there's going to be future parties buying into the business, if there's going to be more acquisitions, personal tax positions, those sort of things will all come into consideration when setting up what sort of structure you're going to go with when you buy that business.
Yeah, perfect. And just from an accounting perspective, when you buy a business, just one simple thing, in certain states, including Queensland, you've got to pay stamp duty if you buy the going concern or the business from the seller. But if you buy the shares in a company, there's actually no stamp duty. And just to throw a third one in there, if you buy units in a unit trust from a seller, there is stamp duty in Queensland. So it's definitely complex. So that's something to work through, and probably on the front end, right? You need to know that the structure of it before you go into signing a contract, and because the name of the buyer would be on the contract. So anyway,
that's right. Yeah. So that'd be, I mean, if you are thinking about buying a business, then have that advanced conversation with with Ben to understand what the right structure is going to be, because that's going to be a large foundation of everything that follows after that.
Yeah, cool. Alrighty. And then one more question that's come through is actually two now. So are the 4 C's the way a lender would value a business, or I guess, is there another way?
That's not really the way they would value the business. It's the way they're going to assess the business from a credit point of view. The valuation of the business will come in a number of forms, and also based on number of industries. So some of those industries that I mentioned before will have a value as such. And again, it's probably not a value in terms of this is what you're going to sell the business for. It's a value in terms of how the bank assesses it to lend against. And it may be a multiple of the income. It may be the assets that are in that business, and it may be the actual value of that business as a going concern. So if I look at a rent roll business, for instance, banks will actually obtain a professional valuation on a rent roll business. And a rent roll business is a business that a real estate agent manages 200 rental properties. They receive a percentage of the rent to manage those properties, and then a valuer will apply a multiple of that rental income to derive a value. And that multiple may be anywhere from 2 times to 5 times, depending on the location of those properties and a number of other factors. So in that instance, the bank will actually get a professional valuation from an external party to understand the value of that business. Whereas potentially with an accounting business or an insurance business, it's a multiple of income that gives the bank an internal value, but not necessarily what that business may actually sell for in an open market, but it gives the bank an internal valuation that they can use. So and then take that to a manufacturing business, for instance. It might have machining equipment, laser cutting equipment, racking, forklifts, all sorts of different things. Again, the bank may actually engage external valuation firms to provide specific values to those assets. So the 4 C's won't give a value, but it will be a framework to the bank understanding and assessing a credit worthiness of that business.
Yeah, perfect. Alrighty. And then jumping back to a question around the purchase structure, working with only RTOs, the only way to acquire an existing RTO, other than setting up a new one, is to purchase the shares. What risks does this new shareholder and the directors take on from an ATO and ASIC compliance perspective? Is that something that you'd say defer to a lawyer for?
Yeah, that's
okay.
That's probably. I mean, I understand where the question's going. It's probably not something that a bank or even myself as a finance broker would try and provide advice on, because it's not really where my qualifications or skills lie. Certainly, if you're buying shares in a business and taking on that existing business, then I would imagine that you're taking on some of those risks, which can include branding risks and other bits and pieces. But in terms of any liabilities or how that may impact you, then yeah, I would definitely suggest a conversation with your lawyer around that one.
Yeah. Okay. That's a definitely fair call, and we might have even had some info on that on one of our previous webinar replays as well. So with Joanna Oakey. So yeah, cool. Well, that is all the questions that's come through. I haven't. Feel free if there's one or two more, but we might actually wrap up the formal part and hang around for a few minutes afterwards if there is any more questions. But thank you very much for joining me on the webinar, Scott, and very informative. You've got a wealth of knowledge. I know I've been speaking with you in detail over the last few months as well, and just your experience is impressive. So thanks again, and our attendees have really appreciated the conversation.
No, all good. Thanks for having me, and thanks everyone for attending and for the questions that came through. Hope I've been able to provide some guidance, some assistance there in terms of where you might be heading with a particular business acquisition, or at least give you some thought prompts to start with. So yeah, more than happy to be involved, and thanks for your time, everyone.
Yeah, fantastic. Alrighty, sweet. We'll see you at the next webinar.
All right, fantastic. Thanks very much.
Cheers.